The argument for a housing crash in the U.S. is getting weaker and weaker as the national market shows surprising strength in the face of record high mortgage rates. In today's video, we're going to look at the latest data for the U.S. overall and assess the current risks that could change the market's trajectory. Let's not waste any time, get straight into it. According to the latest data from Redfin, a national real estate brokerage, the median home price in the U.S. was $412,000 on a seasonally adjusted basis in July, which is up 3% from the recent low of $400,000 in April. This marks an almost complete recovery from the initial drop of the high point of $415,000 set back in May of 2022. What's leading to this strength? Increased demand and a tight supply. The sales to list price ratio has nearly returned to 100, meaning accepted offers are coming in at list price on average. This confirms the uptrend we've seen in this indicator the last few months and signals buyers are becoming more comfortable with the idea of buying a home with a higher mortgage rate. The average days on market is remaining lower than the recent peak set back in March, and home sales volumes have halted the downward trend and are beginning to stabilize. Meanwhile, supply is tightening. The month supply of homes, which measures how fast the current inventory would be exhausted at the current pace of sales, continues to head lower. And while new listings seem to have halted their downward trend, it is stabilizing at historically low levels, which is supporting home prices as supply continues to be constrained. That's what the current data is showing, and it's a clear sign of strength for the national market. A big part of this is a change in buyer psychology. As I mentioned in previous videos, people are starting to get used to the reality that mortgage rates are not coming down significantly anytime soon. Circumstances in life sometimes make buying a new home a necessity, such as relocating for work or experiencing a growing household. The higher cost of financing a home is for some just a reality they have to factor into their financial decisions. But the question is, will this strength we're seeing in home prices continue, or will it be short-lived because of some of the market risks out there right now? First, let's look at the demand side of the market. The home price data I cited earlier is from July, which is the most recent data we have available at the time this video is recorded. We have much more recent mortgage rate data, however, and in August we've seen rates surpass the recent peak of 7.1 back in October of 2022. On its own, this would give potential buyers pause before moving forward with the transaction. And with the Federal Reserve signaling it has no intention of lowering their Fed funds rate anytime soon, we're not likely to see any relief from a drop in mortgage rates in the near future. Quite the opposite. The Fed is leaving the door wide open to further rate increases in the months ahead. So we could see mortgage rates trending towards 7.5% or even 8% before the end of the year if these trends continue. The sale to list price ratio will be a key indicator to watch, as a return to trending lower than 100 would signal buyers are not able to bid competitively with the higher mortgage rate. Assuming we had no change in the supply side of the market, the prospect of even higher mortgage rates in the months to come would take the wind out of the increase in demand we're seeing in the latest data. However, there are some voices out there that are calling for a big increase in supply over the next year that could lead to significant reduction in prices. In a recent video on the YouTube channel Wealthion, Nick Gurley from Reventure Consulting argues that we're going to see an increase in new listings and inventories as a result of pent-up supply that is built up in the market. This pent-up supply is said to be from sellers that ordinarily would have put their house up for sale due to necessary reasons such as a death in the family, a household breaking up, financial distress, or other life circumstance that would ordinarily lead to someone putting their home up for sale. Because home sales have been so low, it reasons that there are a lot of listings that ordinarily would have come onto the market but haven't because mortgage rates are so high. Usually when you sell your home, you need to move somewhere else. And when your current home might have a mortgage rate of around 3%, selling and buying a new home at a 7% mortgage rate could definitely be a reason for putting off the sale. In theory, this makes sense, but unfortunately there isn't a lot of available data out there that would allow someone to accurately measure how much pent-up supply is out there. One factor that could trigger this increase in supply would be some kind of financial distress, such as a loss of income because of a recession. Economic data is something we do have an abundance of, and on my other channel, Papaya Cast, I have a new video looking at the latest economic data and assessing the risk of a recession in the near future. I'll leave a link to that video in the description down below if you want to check that out. The bottom line is that right now, the economic data is strong and we're unlikely to see a recession before the first half of 2024. So there are some risks out there for the U.S. housing market, but right now we're still in a market with tight supply and enough demand to absorb most new listings that come online. If you like this kind of video, I hope you will consider subscribing to this channel if you haven't already, and hit that notification bell down below so you know right away when my next video comes out. On this channel, I focus on forward-looking real estate analysis for the nation overall, as well as regional markets, so you have the information you need to inform your real estate decisions. And don't forget to hit that like button to support the channel, help it grow. Thanks for stopping by, and I'll see you in the next video.